You want to buy stocks from global companies, but you're in a country with limited access to traditional markets. What if you could buy a tokenized version of a company's stock, 24/7, with no brokers or intermediaries? Thinking face. That's the promise of Kraken's xStocks, a service that's making waves in the crypto and traditional finance worlds. It's a bold move, but it's also facing some massive regulatory challenges. So what are these challenges, and could they ultimately derail this exciting innovation? Let's dive in. What is Kraken xStocks? First, let's get a clear picture of what we're talking about. Kraken xStocks are essentially digital tokens that represent real-world shares of companies like Apple, Tesla, or Google. The key difference is that instead of holding the actual stock, you're holding a token on a blockchain like Ethereum. Each token is backed 1:1 by an actual share held by a licensed custodian, but the tokens themselves can be traded on the blockchain 24/7, outside of traditional market hours. This brings some serious benefits: fractional ownership, instant settlement, and global accessibility. It's a game changer for investors who previously couldn't access these markets. But here's where the plot thickens. Regulators are not thrilled with this new breed of asset. The main regulatory hurdles. The biggest challenge is how regulators classify these assets. Are they stocks, or are they crypto? This isn't just a semantic debate, it has massive implications for compliance and investor protection. The U.S. Securities and Exchange Commission, or SEC, sees these tokenized stocks as securities. Why? Because they're an investment in a common enterprise with a reasonable expectation of profits from the efforts of others. If they are securities, then a whole host of regulations kick in, rules designed to protect investors from fraud and manipulation. Kraken's platform would need to comply with the same rigorous standards as a traditional stock exchange, which is a complex and costly process. This isn't a new fight for Kraken. They've already had a run-in with the SEC over their crypto staking service, which the agency also deemed an unregistered security. Collision. Another key issue is investor protection. Traditional markets have safeguards in place, like deposit insurance and strict rules around how client funds are handled. But with xStocks, you're dealing with a token on a blockchain. Who is responsible if something goes wrong? While Kraken uses custodians to hold the underlying assets, the legal framework for this type of service is still very much in a gray area. Organizations like the World Federation of Exchanges have even voiced concerns, arguing that tokenized stocks lack the investor protections found in conventional markets. Grimacing face. Finally, there's the issue of market integrity. Traditional stock markets operate on a set schedule to ensure fair and orderly trading. What happens when these tokens are traded 24/7 on a blockchain? Regulators worry this could lead to market fragmentation and a lack of oversight, making it easier for bad actors to engage in activities like insider trading or market manipulation. The future of tokenized stocks. Despite these hurdles, the demand for tokenized assets is growing, and Kraken isn't the only one in this space. Other companies, like Robinhood and eToro, are also exploring or offering similar products. It's clear that the future of finance is heading in a more interconnected, digital direction. The question isn't whether tokenization will happen, but how regulators will adapt to it. The outcome of this regulatory tug-of-war will shape not only the future of Kraken but also the entire digital asset space. Will regulators create a new framework that embraces this innovation while protecting investors? Or will they shut it down, pushing these services to less regulated jurisdictions? With that said, thanks for watching, and until next time.